A very good morning to everyone. We welcome you to this webinar conducted by Thinkers Forum on 360-degree review of demerger. This webinar is an initiative taken up by Thinkers Forum to address and discuss important topics such as today's for the benefit of members of the forum, corporates and students. And today we have with us three very renowned and eminent speakers, C.A. Sundararaman Sir, C.A. Chinnasamy Ganesan Sir, and Dr. K.S. Ravichandran Sir. In the fiscal year 2024, India witnessed a surge in corporate demergers as companies sought to unlock value and streamline operations and focus on core businesses. Demergers serve not only as means of business separation, but also a strategic approach for tax planning. Prominent entities such as Tata Motors, Reliance Industries, All Cargo Logistics, Vedanta, ITC, and now Raymond have made strategic moves to split their businesses into separate entities, focusing on specific sectors and verticals.
On this note, let us welcome the first speaker for today, C.A.S. Sundararaman Sir. C.A.S. Sundararaman is a partner at Haribhakti & Co. He's skilled in leadership on accounting practice, transfer pricing, valuation, statutory audit, financial risk, internal audit, and corporate finance. Apart from that, he is also a renowned registered valuer. Sir, we welcome you to give your insights on taxation and valuation aspects of demerger and how a demerger, in fact, helps a corporate to unlock its true value. Over to you, sir.
Yes. Good morning to all. Really happy that we are having a good discussion merger, which is now the important event that is happening in corporate world. Especially large corporates have tried to do this in a big way. The latest one being the as the introducer just said. So before we enter into those individual case studies, let us have a look at what are the things that we are going to discuss today. So I'll just share my presentation.
Share option Varda, you are getting it?
There. So, allow things to.
Yeah.
It's visible,
Okay.
sir.
Yes,
sir.
it's very much.
So let me straight get into the sorry. So this is the presentation. First, we will just go into the what is a demerger. When we say demerger, it's a corporate many forms. When some of these are spin-offs, split-ups, and split-offs. Spin-offs is areas where they are already a subsidiary company, and now the subsidiary company shares are distributed to the shareholders. So that also is considered as a demerger. But the process is very easier, and it requires not much of regulatory hassles. Next is split up. Split up type of demergers we come across nowadays, where the parent company splits off two or more separate companies or even its own undertakings into a different listed companies, and the shareholders of the existing company gets the shares of the new undertakings or existing undertakings which are being demerged from the parent company. Are given an option to exchange their shares in the parent company for shares in the subsidiary. So this is typically a case where there is a management divide. What happens is one part of the this happens in the case of family arrangements, where one part of the family would want one part of the company, so they will exchange their shares for the subsidiary shares. This also is a demerger. Now, why demerger? Why does a demerger become necessary for a company? Reasons are, including those specific to family businesses, are focus on core competencies. That is, each leg of the management may have a focus on a specific area of business. So they would like to be away from, and they would like to focus on their core competencies and not get hassled with the other segments of the businesses. So this is focus on core competencies. So this typically happens when you want a very clear arm's length segments or SBUs of a company. So you would want this company to become this SBU to become a separate company, and that team focuses only on the profitability and the production of that segment. The next most important thing which we will be focusing when we look at valuation is the unlocking of the shareholder value. This is now, see, initially when demergers, one of the earliest demerger, if I remember correct, was in the late 80s and the early 90s. The Dalmias, they had their demerger. So that was this is one of the earliest demergers. In fact, people were pondering whether under Companies Act this can come as a arrangement or settlement. Then it was done by Delhi High Court. I think it was in 1990 or 91. Dalmias were the earliest demergers, where they divided their businesses into. If you see, most of the demergers have either been the result out of a family dispute or a family arrangement, or within the company some shareholder arrangements or breaking of the shareholder groups. So that became the focus of all demergers. But if you see, of late, the unlocking of shareholder value becomes the focus. So once this becomes the focus, you will find that there will be a lot of demergers that can happen wherever one segment of the company is not giving the same value as the other segment. Then there could be a very good schemes of demergers which will be win-win for all. This whether it is a win-win for all or not, we will see when we see the case study. Then enhanced strategic flexibility. See, what there could be strategic goals. A particular segment of a company would want a specific strategic alliance with a particular customer or a supplier. Those things cannot be done if it is part of a conglomerate. Then they have to split. Say, for example, they have to be two different entities and they have to be governed as such. Then only you can have the independent entities will have the freedom to enter into any strategic alliance with any of their partners which they would want. That is part of the pursuing of the strategic goals.
So
the improved financial. Yeah, pardon.
So the slide is not moving.
Not visible.
The slide is visible, but we are still on the first slide, sir.
Oh, I don't know.
Yes, sir. Now it's moving. Yes.
Is it visible now?
Yeah, it's visible now.
Sorry. Yeah. Now, improved financial transparency and easier access to capital market. So once you separate this is part of, you can say, value of the business, but this itself can be a core focus area when you do demerger.
The regulatory compliances are also some of the areas. Say, for example, some of the things that happens is you have two different regulations for power generating and power distribution. This happened long back. It was a public sector undertaking which started that. It was NTPC which did, if you see, in that sense of the word, but this was done through a regular notification process of the government, because it was a 100% government company. They made two companies. NTPC was also a generation as well as a distribution company, which they split into National Thermal Power Corporation as the generating company and National Transmission Corporation as the distribution company. That National Transmission Power Limited became PGDCL now. That was part of the regulatory requirement, which required that the generation and distribution should be separated to ensure that there is a focus on the returns that are contemplated on each segment of the business. So, in order to do a regulatory compliance, the government decided to split NTPC and Transmission Corporation into two different entities. Tax benefits. On tax benefits, I will come back. This cannot be a focus for demerger, because the moment you do it, GAR provisions. So we will have a detailed discussion on the GAR provisions later. Then operational efficiency. This is more or less like the core competence on other things. So this is the other reason that could be. Now let us move into tax implications first before we get into the GAR provisions. This definition of 219AA was incorporated in the Income Tax Act long after market. I think this was one of the later amendments that came to exempt demerger from the this one. But previously, the companies decided to say that demerger is part of a scheme of arrangement, and so that was already covered by the definitions in part. But there are a lot of conditions which were very difficult to comply. So many of the demerger, the Income Tax Act was not encouraging demerger in a sense. So then they incorporated this 219AA. If I remember right, this was in 2001, 2, something around that date. Then conditions for demerger are all the properties of the undertaking should be transferred. You cannot have some of the assets remaining with the, maybe the undertaking, if they have surplus assets, they can do a transfer of that surplus asset before embarking on a scheme of demerger. Then all liabilities relating to the undertaking by the scheme, they cannot by the scheme they cannot do a by the existing entities, demerge the company into the resulting company. That they cannot do by the scheme, but the liability takeover can happen, as in the case of property, by a separate thing. But if the assets are charged, then naturally the liabilities have to go along with the assets. The properties and liabilities of the undertaking must be transferred at book values unless accounted for differently in. This, I think, Mr. Chinnaswamy Ganesan will elaborate on this aspect. What are the circumstances in which it can be different from the book values, or it should be different from the book values? Because if there is again there is a gray area. If the accounting is done as per the requirement of Indian accounting standard, but if there is an option and you adopt an option which is beneficial, I don't know whether the department will. Then the resulting company shareholders should be given the shares of the demerged company on a proportionate basis. Then shareholders holding not less than 3/4 in value of the shares. See, here challenges come where there is a family arrangement. One group of the family wants to inherit a particular business, and the other group wants to inherit the other division. So what happens is, 3/4 of the shareholders should be ready to take the shares. Now, if out of 100 shareholders, only 3/4 have expressed their willingness and they don't want to come, as in the case of merger, if they don't want to come, maybe they will be paid money for the shares and paid off and relieved as per the requirement of the Companies Act. But the proportion has to be there. But where there is a split off happening between two groups, and one group takes over one division and the other group, normally what happens, if they are relatives as per the definition of 56(2)(10) and Income Tax Act, then what they happen is the allotment happens as per the demerger, and inter se they transfer the shares without consideration. That happens as a gift. That could be part of the family arrangement between them. So that happens, and till date there has not been any tax issues relating to that. But this is subject to challenge in those cases. But what is there should be allotted proportionate shares at the time during the scheme. Post scheme, there can be a transfer of the shares, and there is no lock-in period for those shares as per the income tax. The transfer must be on a going concern. Now, the definition of undertaking and liabilities, I would like to go faster because there are other issues to come. Then tax implication in the hands of the shareholders. In the hands of the shareholders, the point that is to be receipt of shares is not governed by 56(2)(10) on 2-3 counts. There is no specific exemption from, but it is derived out of the fact that there is no transfer here, because the shares that are allotted are new shares issued by the existing. But in case there is a demerger contemplates exchange of the existing shareholder shares by another shares, then number one, the condition relating to 3/4 proportionate basis also could be challenged. Then this 56(2)(10) issue can also come up. Cost of shares in resulting company is equal to cost of shares in demerger of share assets transferred by net worth of the demerged company. This is a very important thing which we have to see. When we sell a demerged company shares, see, for example, if tomorrow ITC is going to demerge, our expectation is that the shares of ITC vis-a-vis ITC hotels, ITC shares per se could go up. The ITC, even after the carving out of ITC hotel, because there is an unlocking of the value, even though a large part of the assets are transferred. But we have to be very careful when we do this, is because the net worth of the demerged company, the net assets, the net book value of the assets of hotels could be very large compared to the total net worth as on prevailing on the date of valuation. So these could be a very big challenge. The next big challenge is cost is given like this. What will happen if I am going to 2018? So that is another issue which could be a challenge. Say ITC post merger, if I am going to sell ITC shares, whether I have to go by the cost given to this, and wherever I have purchased after 2018, this could hit very heavily also. So this is one issue where we have to focus. Other things, I think period of holding, all these things are all more academic. So let us skip and go forward. Then taxation in the hands of demerged company. In the hands of the demerged company, as long as the conditions are satisfied, the transfer of capital asset is exempt. Okay, and we have to be careful about the WDV of the block of assets in the hands of demerged company shall be reduced by the WDV of the assets transferred in demerger. See here, WDV of the assets transferred in demerger. This is a carving out is a big challenge, because the WDV of the demerger, especially in the case of large conglomerates like ITC and Vedanta, where their assets may date back to early 80s or pre-80s. After 88, all the WDV has got completely, what you can say in Tamil, you can say as Avil. It has become a big soup, you can say. And that is why the carving out is going to be a big challenge. Then taxation, the answer of the resulting company, transfer of issue of shares scheme is considered a demerger subject to the demerger conditions. Then WDV of the assets to be the WDV of the transferred assets. So whatever you have deducted, whatever you have carved out for the purpose for the demerged resulting company will have to be deducted from demerged company. What you deducted there should be added to here, should be taken as WDV for the purpose of depreciation. Then these are some of the conditions which are there. I think I will skip these slides. Then foreign company also, 3/4 of the shareholders in the value of the demerged foreign company should continue to be. Shares of an Indian company held by the demerged foreign company is also exempt. They do it through a demerger, and the court approval is taken in India. So this will effectively blunt the Section 9 challenge that is faced by entities which are holding Indian company shares.
Screen not moving, Sundaram.
Again,
are you moving to another slide?
Sorry, again.
That I think every slide I think you
coming.
should check.
Now it's coming.
Yes, now it is GAAR. GAR.
Yeah. Now does it move now?
It is just static at GAR.
Oh, why? I don't know.
Maybe you need to move it and.
No, I'll stop sharing and then again share.
Yeah. I think when you put it full mode, the screen moving is not happening. If you go back to the normal mode and move it, then go to full mode.
Does it move now?
Yes, this is now effect of GAR on demerger,
okay?
Scrutiny of purpose.
Is it okay?
Yes.
Yeah. Now, this is a very important topic. I feel that we need to, I think, attention of Dr. KSR also is required for this issue that can come up in GAR. See, general anti-avoidance rule is a set of regulations that have come to prevent tax avoidance by scrutinizing transactions and arrangements that lack commercial substance and are primarily intended to achieve tax benefits. So flagged the issue that tax benefit has a purpose for demerger. It can be primarily intended. It cannot be a primary purpose. It can be a unintended consequence of your primary purpose. I would put it that way, because even if it is one of the benefits, there is a huge onus put on the assessee to prove that it is not the primary. So this is a very important thing that is to be noted. Empowers the tax authorities to disregard. See, there are other things which they have said that they will levy tax on the. They will disregard the arrangement and levy tax. That is okay. If they say that demerger I disregard, I am going to levy tax on the demerged company, all those things. But they can even say, or this split off itself we will not recognize, or we will exclude one portion of the scheme. They can divide the scheme and say this portion of the scheme I will not accept, or this portion of the scheme I will not accept, because this particular item is only intended for tax benefit. So if they are going to do that, see the consequences we will see. Disregard. Tax authorities can disregard or recharacterize the demerger if it is primarily, say, if they of taxation of a single item, it's okay. But if they recharacterize the demerger, then the whole thing goes into a confusion. Now, here, let me come for the scrutiny of purpose. If the primary motive of demerger is found to be tax avoidance rather than genuine, then GAR can be invoked, in which case the entire scheme can be disregarded. 2. Commercial substance. GAR requires that the demerger have a genuine business purpose and substantial commercial substance beyond just obtaining. So demerger have a genuine beyond that. But please note section 96(2) provides an arrangement shall be presumed unless it is proved to the contrary by the assessee to have been entered into or carried out for the main purpose of obtaining a tax benefit. If the main purpose of a step-in or part of the arrangement is to obtain tax benefit. So if a part of the arrangement is for tax benefit, that particular part, say for example, if you are doing a demerger and you will get a huge, now one of the subsidiary is making loss. You now bring this subsidiary making loss into that demerger and merge with the entity, then they can say this is a step-in, I will not accept. And this will have consequence not in a single assessment year, it will have consequence over the period. So if that step-in is not agreed,
unless the, can we say, unless the resulting company is already carrying on the same business?
No, whatever business, if they find that this is done, this one, I mean, I've just referred to this Arvind Narotam decision. I just bookmarked some of the observations of this Arvind Narotam decision. It is the philosophical part when Sabyasachi Mukherjee countered McDowell's. But the last line, where the true effect on the construction of the deeds is clear as in this case, the appeal to discourage tax avoidance is not a relevant consideration. But since it was made, it has to be noted and rejected. With these observations, I agree. The decision is, where if you see inside the decision, there is one very clear the true effect on the construction of the deeds is clear. So if a scheme is clear that there are business purposes, they cannot, even after 96(2), the assessees have the right to challenge this based on this CWT versus Arvind Narotam, which effectively negates McDowell's decision. Though McDowell larger bench, we can take this as a distinction to McDowell's by the Supreme Court. So this is a very important decision, you know. But in this case, if they disregard, now what will happen to the consequences? So one thing is, okay, we challenge this, go to Supreme Court and this one. But during the interregnum, what will happen to the financials of both the companies? How this will be affecting? Now, contrary to this, this is a possibility. But contrary to this, here is a decision where even though the income tax department objected to it, while the right of the revenue is to be protected, there is no bar in streamlining the affairs of a company with its wholly owned subsidiary. The Act provides for such like situations to enable companies to offset losses against profit. Therefore, it cannot be said that such a scheme would be against the interest of the Revenue Department. The provision of Section 72 of the Income Tax Act shall be wholly applicable, and in the event of any liability still accruing, the same shall devolve. So what they say, okay, if it is not, let the transferring company. See, one thing is the consequences, I don't know, the NCLT has observed this. But is there a provision in the scheme to deal with if the income tax department does this? If there is no provision in the scheme, who will bear the, especially when there is a demerger, there are two groups and one group takes the other shares, they have transferred the shares, what will happen to the assumptions in valuations and other things based on which the scheme was drafted? Any deficiency found or violation committed via any enactments, the sanction granted by this court will not come in the way of action being taken. So all these caveats are good, but whether the scheme per se, whether the NCLT should also insist that in the event of tax not agreeing to that, what will be the impact and what will be the effect? and who will bear that? Should not the schemes be drafted? And to my view, from the schemes that I have seen, are not dealt with. Such consequences are not foreseen or not dealt with. But especially in view of the GAR provisions, large conglomerates at least should have a specific para on what will be the impact if GAR is applied. What will be the consequences? If that be the case, is there any contingency fund or anything earmarked in the scheme which will be used for additional tax liability? I think such insistence should come from the judicial authorities hereafter, especially if GAR is going to be invoked. So now next, let us move on to the next thing, valuation part. Valuation part, importance is valuation is essential in a demerger depending upon the purpose for which it is done. And mostly, even though many approach valuation that is resorted to is mostly a relative approach. Whatever you adopt for the demerged company, you adopt it for resulting company, and then arrive at what is the business value of both, and then go for the exchange. So, what are the shareholder value? How does it improve? So, I think we have now some limited time. So, let us jump to how this has impacted shareholder value. That will be of interest. So, let us take 3 demergers. One is in the offing, the other 2 have happened. BEML is a public sector company which did a demerger. What they did was they demerged. This is typically a demerger which you will find that many companies will resort to in the next 5-10 years, because this is going to be, because the market is now moving in a particular direction. So the companies have to realign themselves so that they get the benefit out of the market. So this is, I think, one of the best thing that has happened is the public sector doing this. BEML lands and put it under a separate company called BEML Land Limited. And you will be surprised that the record date for this, so this is the section 9. This is the thing. See, the record date for this, I have not brought the full picture, but I like to say that, see, this is the market capitalization as on 31/3/2024. BEML Land Limited is 925. On 31/3/23, this was that. What is the huge improvement? Improvement is on account of, if you benchmark it with Sensex also, this has far exceeded the Sensex. Maybe there are all defense sector. Even if you discount that, this particular land demerger has benefited this company so much. If you see on 7/9/22, the BEML share price was 1831. Okay. On 30/9/22, it went down. But then, if you see, the market itself was going down. But if you see on the next day, the record date was 1831. The next few days, it was increasing because they felt that the performance of this company will improve as compared to the existing structure. So this is the important thing. If you see here, during this period, Sensex has come down this much. It has exceeded the Sensex performance, except on 31/12, 39 to 30/12. But if you see all other places, it has exceeded the Sensex performance very largely. Now, if you take the next is Bajaj Electrics and Bajaj Projects Limited. Bajaj Electrics have got a consumer durable division where they sell all the electrical equipments and things, large and small also. And then they merged their projects EPC division into a separate company. But in this case, this has not given much of result as in the case of Bajaj Electric, as in the case of BEM. Why? Because both are considered as okay aligned businesses. Over a period of time, you may find that these here, I feel that this particular demerger is more for strategic. See, you will have a separate investors, group of investors who will come for projects and who will have their return expectation is different and the condition is different. So that over a period of time, you align your balance sheet to the respective industry sector. And so that in the market, your multiple are comparable and also you are able to attract the same investment as the others. Now, ITC we will come. We will not look into what will happen to the market and other things. Let us look at why this thing. The demerger is focused on hotels, but I feel that they may focused on cigarettes separately and why they have not done maybe obvious reasons. I'll come to that later. Let us look at the segment results, which will give a rationale for the this. If you see here in sales, cigarettes constitute 38%. Always they say we are no longer dependent on cigarette because our sales, which was in good old days when we were doing our articles, ITC used to have about 60 to 65% cigarettes, and almost the other part was paper, and even paper, most of the paper will be for the purpose of cigarettes. So cigarettes constitute 38%. Others, this others is mainly FMCG, because they have this Ashirwad Atta quality, this what is that Sunfeast biscuits, so many brands. So all those things come under this. Hotels, they constitute only 3% of their total revenue, and agri business constitutes 15,000. And in this agri business, then paper board, paper and packaging. So this others is FMCG, which is mostly, I'm sorry, this agri constitutes that food and agri business, which has this Sunfeast and other thing. Others are FMCG, like other cosmetics and also the various other products of ITC, which are FMCG, typically the Colgate, Palmolive, all those competitors. Then paper and boards. Paper and boards also the only notebooks come under the FMCG. Notebooks and stationery come under FMCG for them. So these things are the segment sales. So we have seen the sales. More or less it is well distributed, except that hotels have a very small share. Now with this, let us go into assets. If you see the assets, cigarettes constitute only 21% of their assets, and hotels constitute 15% of that, while 3% is their revenue. Now you go to the EBIT, it is completely different. Cigarettes constitute 7%. So they are still cigarette dependent company, tobacco dependent company. And FMCG is constitute, and hotels constitute only 3% of their, I mean, their turnover is 3%, their profits also is 3%, but they have asset of 15%. That is why what they want to align their EBITs with the market multiple, so that they will get a better value. The shareholders will get better valuation. But even here, I feel that again, if they have a separate cigarette company and things in a separate entity, the tobacco company will yield high multiples. So this is the valuation part, which is very important for demerger. I think with this, I have completed my presentation. I think we can come back in the last segment if there are any questions.
Yes, sir. Thank you, sir, for the insightful presentation. Our next speaker for the day is CA Chinnasamy Ganesan, sir. He is presently the Senior Partner and Head of Audit and Assurance of CNGSN and Associates LLP, Chartered Accountants, Chennai. Sir specializes in financial reporting, company law matters, audit and taxation, and was conferred honorary doctorate in IFRS, and is also recipient of the Jewel of India Award and Certificate of Excellence for his role and contribution in the field of financial services. Sir, we welcome you to give your insight on accounting implications of demerger. Over to you, sir.
Thank you. I will just share my screen.
Yes, sir.
Are you able to see my screen now?
Yes,
The
sir.
presentation.
Yes.
And the presentation is also moving, right?
Yes, sir.
Okay. Because KSR always gives a warning signal. So I wanted to ensure that I'm also not making the same error by oversight. Because even an error by oversight is not being considered as an ignorance, and penalty will be levied by the Ministry of Corporate Affairs. So thank you, Thinkers Forum, especially Dr. KSR and his team for arranging this nice interaction. In fact, when we normally talk about a business combination, we normally consider it as a acquisition and other activities. When we were talking about 360-degree of demerger, I was wondering what is actually in store. And especially when the accounting aspects of demerger has been asked to be handled, I was just having my own pleasant surprise in some of the understanding on demerger and the accounting implications are being unfolded. So let me start with the demerger under the Companies Act, because Section 230 and Section 232 of the Companies Act is actually talking about whether a demerger is possible by transfer of one or more undertaking to any resulting company. And this particular sections are also deals with the scheme of arrangement through which this particular demerger can happen. When I am looking at the probability of how a particular activity can be considered as a demerger, I'm also taking the clue from what Mr. Sundararaman has talked about from the income tax angle, certain salient features of the demerger. One is all the property and liability of the undertaking becomes the property and liability of the resulting company. If you have, say, the entire business is being demerged, that could be one possibility. Or there could be a possibility that a demerger happens only for one particular vertical as per the various case studies Mr. Sundararaman has actually shown to us. If one vertical has been spinned off or demerged, then the property, liability, or the assets and liabilities of that particular vertical will be becoming the assets and liabilities of the resulting company. And the interesting factor is the accounting aspects is very clearly talking about the property and liabilities, or the assets and liabilities are transferred at book value. And the tone has been very aptly set by taking the taxation implications as the first point rather than the accounting point. Normally, we believe that because of the accountants, the taxation issue arises. So now you already have a solution for what is the taxation related issue. Whatever accounting complications I create, I think that it will be already taken care. So the third is that the resulting company will be issuing shares to the shareholders of the demerged company on a proportionate basis. So whatever is the value of the assets and liabilities which has been transferred, the net asset value, to that extent, there will be a swapping of the share capital, which will happen. And income tax expects that the shareholders holding minimum 75% of the voting of shares should also continue to be the shareholders of the resulting company. In other words, if you look at this particular requirement of the Income Tax Act, in all these cases, it will result in a common control transaction. Just for drawing a parallel for any activity relating to merger, demerger, acquisition, etc., whether that will be falling under a common control transaction, this particular aspect will very clearly make it as part of the common control transaction. And the expectation is that the transfer of an undertaking is always on a going concern basis, so that the resulting company will continue that particular business. Okay, that is the reason why what is the revenue implications arising out of the accounting treatment, whether it is a tax neutral or otherwise, is also being dealt with in the previous session. Now, I'm just looking at two accounting standards which are dealing with this type of business combination, amalgamations, mergers, etc. One, as per the accounting standards, which are applicable to normal companies who are not following Ind AS. So the accounting for amalgamations, when we are saying AS 14 comes into the picture, what it says is that it is an amalgamation. Amalgamation means is an amalgamation pursuant to the provisions of the Companies Act 2013 or any other statute which may be applicable to companies and includes merger. So they are talking about amalgamation. They are talking about merger. So that means one company can acquire another company and amalgamate. One company may merge with other company. It could also be possible. And as of now, the word demerger is not coming into the definition at all. So it is talking about amalgamation. It's specifically talking about pursuant to the provisions of the Companies Act 2013 and then or any other statute. And finally, it also says it's a merger. So what is interesting is that there is no reference of demerger or no reference of spin-off in the entire accounting standard. And accordingly, there is no specific guidance available for demerger or spin-off in the accounting standard 14. That's the first shock which I had when I was preparing for the entire presentation for today, that there is no accounting guidance available as per AS 14. Then comes is the next one, Ind AS 103, companies who are following the Indian accounting standard. So let us assume that majority of the discussion which we are going to have is in respect of companies who are following Indian accounting standard, maybe listed companies or large unlisted companies. Okay. In business combination 103, it says a business combination is a transaction or other event. Contrary to what we were talking in AS 14 amalgamation, the way in which business combination is talking about is completely different. It says is a transaction or other event in which an acquirer obtains control of one or more businesses. Again, when we are looking at this particular definition, the important points comes is that there should be a transaction. Maybe a transaction is one company is acquiring another company by means of entering into a business purchase agreement. Various other activities are involved in that particular transaction. Could be a direct acquisition of one business, or it is allowed another company to get acquired, to acquire this particular company. Okay. The second is, it also talks about a case of other event. It's an interesting point. It's not in the accounting standard, but in Ind AS, it's interestingly talking about one entity acquiring control over one or more businesses. So obtaining control is a key. For obtaining control, if you look at Ind AS 110, which talks about the definition of control, it makes out very clearly that shareholding pattern or voting rights alone is not the basis for determining who is controlling the other entity. In fact, the concept of control, when we were talking about business combination or consolidated financial statement, says that when you look at the voting rights as the first starting point, you also look at what is the voting rights of the other entity. For example, I hold only 30% voting rights in one entity, and the remaining 70% of the shareholding is widely spread, and there is no one single group which could control the 70% or more than 30%, let us assume. In that case, what happens is automatically, even though I hold only 30% shareholding, I am becoming the controlling stakeholder, and all the 70% of the shareholders will be considered as a non-controlling interest. Now, let us take another example. Let us assume that there is a case of two groups. One group is holding, say, for example, 40%. Another group is holding, say, for example, 60%. And these two entities are maybe, we'll take 40, and 20 is widely spread. And the entity has offered a buyback of shares. The one group which is holding 40% has not opted for the buyback. The other entity, which is holding 40%, has taken a buyback. Okay. When this buyback has taken, assuming that it is reduced the shareholding to 20%. So what happens is, with 40% on the resulting 80%, one entity is continued to hold 50% stake, or it has the controlling stake. So accordingly, even though I have not done any transaction, even though I have not acquired another entity, just because one event has happened, the control is becoming in my favor, and I become the owner or the controlling stakeholder of the particular business. Okay, so a transaction can also happen, or just an event where I'm not involved, which gives me a control of the entire business, maybe one business or more business. So when we look at this analysis as well, what I was seeing is, here also there is no reference of demerger, there is no reference of spin-off. It's only talking about two transactions. One is the acquisition of one or more business by which acquirer obtains control. The other transaction which they are talking about is a common control transaction where business combinations are acquiring. It is not specifically dealing with demerger or spin-off. When both the accounting standard, which are specifically talking about business combination or purchase of business or amalgamation, is not giving any guidance on demerger or spin-off on the accounting treatment, I was just looking at how we will look at the accounting for the business combination, which is arising out of these two transactions. One is the acquisition method, as I have already mentioned, where one company or one entity is acquiring the control over the other entity. We will account it as a purchase method or the acquisition method as given in Ind AS 103. Suppose if the transaction is happening between the common control transaction, say for example, A Limited is the ultimate parent company and it has 4 subsidiaries, and the 4 subsidiaries are merged into 2 subsidiaries. This acquisition is only nothing but a common control transaction, because prior to and after the acquisition or business combination has happened, the control remaining at the same party. Okay. In that scenario, they are saying you go by pooling of interest method. You are aware that pooling of interest method is nothing but adding or aggregating each and every asset and liabilities, retaining the identity even with respect to the reserves. Very rare circumstances, capital reserve may arise in a pooling of interest method. But in an acquisition method, you normally transact the entire activity by means of fair value of assets and liabilities taken. And also there could be a possibility of goodwill or gain on bargain purchase, which we route it through other comprehensive income, may also arise. We call that as a capital reserve in Indian in our accounting standard. Instead of that, we are saying that it's a gain on a bargain purchase, which will be routed through other comprehensive income. It is not taken to the profit and loss account. So this is the accounting treatment which is available under Ind AS 103. But Ind AS 103, if you look at the application guidance or the educational material issued by the institute, has very specifically mentioned that you have to give a special consideration in respect of acquisitions made based on code schemes. Here we are coming into the real area which will be helpful for us to understand. So the standard understands that there could be scenarios where the acquisition may be done through a scheme of arrangement or by means of framing a code scheme approved by either NCLT or the other case may be. In the previous circumstances, it will be through the court. So if this acquisition is happening, interestingly, the Institute of Chartered Accountants of India, when framing Ind AS 103, has considered that the law has an upper hand over the accounting standard. Or law prevails over the accounting standard is what the conclusion which has been drawn by drafting the Indian accounting standard. And accordingly, when the code schemes are considered as a separate set of activity, anything which you are doing with a code scheme, you have to look at how the accounting comes in. Interestingly, every court scheme requires a declaration by means of auditor's certificate. In the scheme, the accounting treatment prescribed is in line with the accounting standards or the generally accepted accounting principles. If there is any deviation, normally now deviations are not being considered in any of the schemes. Sometimes there could be a possibility of considering certain adjustments over and above what is prescribed in the accounting standard. Then in that case, the accounting treatment will be in accordance with the scheme prescribed. We had standard board when Ind AS 103 is being discussed. And one question has been raised is that either the accounting standard AS 14 or Ind AS 103 at the draft form is not giving any guidance relating to court schemes. Because we say law prevails over the accounting standard. Suppose if the court scheme prescribes a different accounting treatment, whether that will prevail over Ind AS 103, Institute has said that it will be in accordance with the scheme approved by the court or approved by the NCLT. So accordingly, indirectly the council has confirmed that the accounting treatment will be as determined by the scheme approved by NCLT or the court as the case may be. Let us look at this. Again, in this particular activity, there is no specific guidance given for demerger or spin-off, excepting that there is a reference to accounting treatment relating to court schemes. That's the only thing which is coming in. Accordingly, I was looking at what could be the better way of looking at the accounting treatment. Fortunately, the ITFG Bulletin 16, question number 6, ITFG Bulletin, you know that this is relating to Ind AS Transition Facilitation Group formed by the Accounting Standard Board for issuing guidance on clarifications asked by the various stakeholders relating to application of a particular Indian accounting standard. In that Bulletin 16, question number 6, there was a specific question which has been raised with respect to court or tribunal approved scheme of demerger. What should be the accounting treatment? What the conclusion is they have said in that particular answer, the accounting treatment approved by the court or tribunal need to be followed in such cases. So that means whatever prescribed in the accounting standard will be kept aside, but what is prescribed in the scheme will be the accounting treatment which has to be done. And of course, there is an overriding principle brought in by SEBI by saying that certificate should also talk about whether there is any deviation from the accounting standards in the case of accounting treatment as per the scheme of merger or demerger as the case may be. So that's an overriding principle, so that there is a restriction that you have to follow the principles given in the accounting standard. But since there is no guidance in the accounting standard, if there is no accounting treatment or there is an accounting treatment which is not in accordance with the Ind AS, then the financial statement of the acquirer should have a proper disclosure in respect of such deviation. In fact, the auditors, when they are issuing the certificate, they also give emphasis of matter saying that the court scheme has allowed an accounting treatment, but it is not in line with the accounting standard that they will bring in that particular scenario. Suppose if it is not a demerger as approved by a court or tribunal, but the demerger of the business is from parent to its subsidiary. That's what a normal scenario of demerger which we normally discuss about. As you have seen in the various case laws presented by Sundararaman sir, you have seen that the purpose of demerger is itself is to derive synergies in operations as well as ease of doing business and better market capitalization. So accordingly, a parent company may be demerging a business to its subsidiary. In that case, they have mentioned in the question, you should follow pooling of interest method given in Ind AS 103. The moment I'm saying pooling of interest method under Ind AS 103 shall be applicable, I normally draw a parallel that one accounting framework, when it is talking about pooling of interest method for a particular demerger from a parent to its subsidiary, same parallel can also be drawn to another financial reporting framework for the accounting standard as well. So not necessarily for other amalgamations, merger, etc. Still, I can apply the pooling of interest method for AS 14 cases also, even though there is no specific guidance, drawing this interpretation from ITFG bulletin, which has been given. Yes, further strengthening of this argument on the accounting treatment comes from the decision made by the council in one of this, where they said, if an item of the financial statement of a company is treated differently pursuant to an order made by a court or tribunal as compared to the accounting treatment prescribed in the accounting standard. That means nothing but accounting standard prescribes a different accounting treatment, but the scheme is prescribing certain accounting treatment. And the scheme has been approved by court or tribunal. Let us understand that they only said the accounting treatment should not be done. They are not talked about. They only said the following disclosure should be made in the financial statement of the year in which different treatment has been given. That is on the year in which the demerger has been accounted for. We should make a following disclosure in the financial statement. The first disclosure is what is the accounting treatment made along with the reason that the same has been adopted because of court and tribunal order. This is where a lot of companies are trying to give an emphasis of matter, saying that since a court or the tribunal has given a different accounting treatment, that has been done. However, it is not in accordance with the accounting standard. Since the law prevails over the accounting standard, the audit report is not qualified. It is only made, includes any emphasis of matter in the audit opinion. The second is, what is the difference between the accounting treatment prescribed as per the accounting standard and what is followed as per the order or as per the scheme? So what is the difference in the accounting treatment? And third, the financial impact, if any arising due to the difference, should also be disclosed. So in looking at this council decision and what we have discussed in the ITFG bulletin also, it is very clear that in case if there is a different accounting treatment permitted by court or tribunal, still that will prevail over the prescription given in the accounting standard. Only additional requirement is to make a proper disclosure saying the deviation, the impact of the deviation, and whether it is approved by the court or the tribunal as the case may be. Now the question which is coming to us is, what should be the accounting steps? If I'm looking at the accounting step in a pooling of interest method, what I'm supposed to do, I will aggregate the assets of the transferor company and the transferee company and make it as a single number. Whereas here, I'm not acquiring the company, I'm not merging the company, I'm actually demerging the company, and accordingly, the demerged undertaking, the assets and liabilities of the demerged undertaking transferred and vested with the resulting company will be reduced from the financial statements of the merging company. For example, A Limited is demerging one of its vertical to B Limited. Then the assets and liabilities of the demerged undertaking, that vertical, should be reduced from A Limited line item of assets and liabilities and will be added to the balance sheet of or the assets and liabilities of the resulting company B Limited. And what is the value at which it has to be taken? Respective carrying amounts, not at fair value, because pooling of interest method is not permitting you to have fair valuations, and accordingly that is not being done. Interestingly, if you look at Ind AS 103, in the acquisition method or the purchase method, which we loosely called, it also looks at what is the fair value of the assets and liabilities of the demerging company? And is there any other new assets or liabilities which is not recorded in the balance sheet, but have a value for the other company? For example, if some of the patents or technical know-how has been written off by the demerged company because they felt that it doesn't have any economic benefit for them, but when it is being acquired by another company, the other company believes that that technical know-how can be used. It is a identification of a new asset or liability not recorded in the balance sheet that will also be considered for arriving at what should be the net fair value of assets taken over and what should be the capital reserve or the goodwill, as the case may be. Whereas here, no new assets and liabilities are recognized by the resulting company. Third, because it becomes A Limited is demerging one vertical to B Limited, and it is under the common control transactions. Normally, it is a common control transaction. Naturally, what will happen is the intercompany transactions and intercompany balances, actually intercompany balances, because transaction is only relating to profit and loss account. Intercompany balances will get eliminated and will get cancelled in both the companies. For example, the demerged company is having a, say, maybe it has given a loan to a vertical, or maybe it has an outstanding balance of some advances to the vertical, and that vertical has been moved to the resulting company. Then a liability and asset will not be recognized, but it will stand cancelled. That amount will get cancelled, nullified. That's what they are talking about, this particular transaction. The difference between the carrying amount of assets and liabilities of the demerged undertaking shall be added to the carrying value of investment in the resulting company, because normally you will not issue any consideration over and above the share capital, and there could be a possibility that there will be some difference between the assets and liabilities taken over, and that will be added to the investment already you have made in the books of the demerged company, and that is what you will consider as an investment made in the resulting company, and the resulting company will have that as a share capital. Okay, that is also a very simple accounting understanding. In very rare of the rarest circumstances, if share capital or consideration has been paid by means of issue of shares to the shareholders of the demerged company, and that was over and above the value of the assets and liabilities taken over, there could be a possibility of capital reserve comes in. Very, very rare and rarest circumstances. But since they are talking about the pooling of interest method also talks about a scenario where the capital issued plus any other additional consideration given minus the share capital of the transferor will automatically considered as a capital reserve. So we are considering that also as an accounting step. The interesting point is, because it's a demerger, the financial statement of the current year, after you have given the effect for all the business combination, should also be considered as if it has happened in the previous year also. In other words, the comparatives of the current year should also be restated. So current year number plus comparative of the current year, which is the previous year number, should also be restated as if this particular demerger has happened at the beginning of the previous year itself. So a user can understand what is actually demerged assets and liabilities and what is the demerged entity and what is the position of the resulting company. This is a simple accounting steps which is involved, bringing the reality based on the pooling of interest method. Let me look at what could be the possible accounting issues which may arise out of this particular accounting which is being done for a demerger of the activity. One could be a possibility of the appointed date which you will consider in accordance with the code scheme for making your entries in the books of accounts. Whereas if you look at Ind AS 10, which is talking about contingencies, etc., in Appendix A, they are talking about giving the effect on the effective date. So the appointed date and effective date may be different. And to that extent, the accounting treatment which has been recorded for the demerger could be different. The moment there is a deviation, what is required? We are supposed to bring in an emphasis of matter saying that the transaction has been recorded on the appointed date instead of the effective date as per Appendix A of Ind AS 10. And to that extent, it is not in compliance with the requirements of Indian Accounting Standard 2015 as amended from time to time. That's an emphasis of matter, but it's not a qualification. The second issue which I could understand is when you are demerging a particular vertical, what will happen is you have to necessarily identify and value the assets, liabilities, even contingent liabilities relating to that particular vertical which is being demerged. So a detailed closure of books may be required, or detailed validation of the closing process may be required, and also how you are allocating the assets and liabilities. Say, for example, if there are some common assets which is being used by two verticals, now when you are demerging, the common vertical will stand in one particular entity and not to the other entity. How you are going to allocate the value of the assets, liabilities, and even the contingent liabilities to the resulting company could be a challenge where a detailed effort may be required to be done. The next question which comes is a demerger or any activity which is run through a scheme of arrangement will involve legal cost, advisory cost, or sometimes valuation cost also, which are directly attributable to the demerger. What is the accounting treatment for the costs? Normally, according to the accounting standards, these are not giving any economic benefit to the assets. Accordingly, it is not considered as addition to the value of the assets. It will be expensed within the profit and loss account. When you are expensing with, there are different accounting treatment people are considering, either through the profit and loss account or through the share premium account. Even if you are adjusting through the share premium account, it is also permitted. It's not a case. So it depends upon how the company wanted to consider that. The second or the next issue which we are supposed to look at, the equity instrument issued for consideration, issued as a consideration for the demerger, including any share premium or discount, if any, arising on such issue. Interestingly, if it is only equity instrument, that is the consideration, your accounting treatment may be simple because you might have already arrived at what is the difference between the net assets, and for that you are issuing shares, and naturally you will also work out what is the taxation impact when you are dealing with, say for example, closely held company, whether there could be an issue relating to 56(2)(10) of the Income Tax Act will have an implication. So you will work out what is your fair market value, and based on the fair market value, you will have that. That's the reason why Sundaraman sir was also talking about the valuation. So if there is a proper valuation of investments, equity investment, there will not be any much issue in the accounting. But let us assume that the consideration is not only paid by means of issue of equity instruments, but also by means of issue of, say, for example, let us assume that you are also issuing what we call as, say, for example, compulsorily convertible debenture or compulsorily convertible preference shares. The accounting treatment goes from just this accounting standard. It will also requires your evaluation under Ind AS 109 relating to fair value measurement. You have to consider what is the rate at which it has been issued, whether it is a market rate or the coupon rate is less than the market rate. In that case, you have to fair value those items to recognize in the books of accounts, splitting the equity and the liability portion separately. All these things will come as an additional complication in case if the consideration by the resulting company has been managed by means of not only equity instruments, but also other instruments. Then the next issue which I could consider as an accounting issue is that there could be a possibility of new related party transactions arising, or new related party relationship is arising out of this demerger process, because of how the control should be evaluated, how the significant influence should be evaluated under the accounting standard Ind AS 24, as well as under the Companies Act, as well as under the Income Tax Act. There could be a lot of possible accounting issues which may arise in identifying the related party, nature of relationship, related party transaction, and whether the disclosure is adequate in accordance with the requirement. And of course, there could be possibility that when the transfer is happening, the transfer may also happen with respect to certain employee benefits. For example, when I'm demerging a particular vertical, all the employees of that demerged entity will also go to the resulting company. Fine. Question could be, is it with continuation of service or without continuation of service? If it is not without continuation of service, how the employee benefits resulting from, say, for example, gratuity, pension, etc., has been taken care by the demerged undertaking, or what is passed on as a push down cost to the resulting entity. So the second possibility could be, if the continuity of employment is actually going to the resulting company, the accumulated balance of liability up to the date of the appointed date is not the cost of the resulting company. It is actually the cost of the demerged entity. So how they are planning to account for that, how it is being determined and apportioned between their liability and what is the new liability for the resulting entity is one question. The complication will be further added if there are some share-based payments or ESOP schemes which has been given to the employees of the resulting company who are continuing from the demerged entity. Because Ind AS 102 on accounting for ESOP transactions are little complex and also requires a lot of valuation techniques to be utilized. And to that extent, the accounting will also comes as an additional accounting issue. So these are all the major issues which I am considering. Maybe to the case-to-case basis, there could be additional issues which may be arising out of that. And what could be the comprehensive disclosure requirement as an accounting implication? I believe that the nature of the demerger should be very comprehensively disclosed as part of the financial statement of the resulting company as well as the demerged entity. In both the cases, there should be a disclosure. Why they have planned for the demerger should also be part of it. Here you have to be a little careful what the GAR provisions which Sundararaman sir was mentioning, whether anything will be interpreted that it's a tax avoidance arrangement. Because of that, that department will have a different view with respect to the demerger. Also, you have to look at when you make this particular disclosure. And in case if there is a deviation based on the scheme of arrangement which has been approved by NCLT or by the court, as the case may be, you have to talk about the compliance or deviation and the effect of the deviation also to be disclosed in the financial statement. And most interestingly, this is actually missing out in every discussion. But what is interesting was from the point of view of the demerged entity, there is a discontinuing operation, right? So to that extent, not only the accounting standard relating to merger, demerger, we have to look at, we should also talk about whether the disclosures relating to discontinuing operations and assets held for sale as per Ind AS 105 should also be made in the financial statements, both in the balance sheet as well as in the profit and loss account and notes on accounts, and of course even in the cash flow statement of the demerged entity should be made or not. The answer is it should be made because it's a discontinuing operation, and accordingly you have to very clearly make the extensive disclosure requirement required under Ind AS 105. I think with that, I will stop my discussion on the accounting implications arising out of it. And any questions after Mr. KSR has finished, that's what the moderators have told me. We will take the questions along with that. And of course, the slide deck, what has been told by my moderator is that I will share that presentation also with them so that it can be circulated to the members of the Thinkers Forum. So with that, I pass on the proceedings to the moderators of the session.
Thank you, sir.
Thank you, sir. Our
Thank
final
you.
speaker today is Dr. K.S. Ravichandran. Dr. K.S. Ravichandran is a fellow member of Institute of Company Secretaries of India, is a founder and managing partner of KSR & Co. Company Secretaries, having head office in Coimbatore and branch office in Bangalore and Chennai. He is an expert in company law, SEBI laws and regulations, FEMA laws and regulations. He represents before various tribunals, and he holds a doctorate from the Department of Management at Alagappa University on prosecution of directors under Companies Act and criminal law, both in India and UK. In this note, we welcome you, sir, to give us insight on the NCLT procedures in relation to demerger. Over to you, sir.
Good afternoon, everyone, and it's very interesting to keenly listen to the experts, Sundararaman and Chinsami Ganesan. A wonderful presentation they have made, and I am trying to see whether I will be able to add some more value to whatever they have done. So wonderful presentation. I would first compliment, and also I have to take a special, I have to mention special thanks to them for bringing out such a beautiful presentation on the topic of this demerger and 360-degree view of demerger. So really wonderful. And when we are talking about demerger, generally we consider demerger for various purposes. Actually, the most important thing which I have seen in my practice in all these 32 years is whenever we talk about demerger, we discuss about some family arrangements, partition, initially it may be a diversification, and later on it would have acquired some value. Then there will be a value realization, monetizing opportunity and all. It is that is how it happens actually. And we also see demergers happening in dispute resolution, in shareholder groups having disputes. So there could be dispute resolution device. Demerger can be a dispute resolution device also. So there are a lot of such opportunities in demerger, and demerger as such, though the word demerger is not found in the Act, whether Income Tax Act or Companies Act. Under the Companies Act, it is a wholesome language of scheme of arrangement, and there is no definition of scheme of arrangement. Even the word arrangement is a very comprehensively defined word under the Companies Act, which has just given an inclusive definition of, indicative definition of, it could be reorganization of capital also. That is why I always tell, this is an area, that is scheme of arrangement is an area where I would take Chinnaswamy Ganesan once again, that we can, write poetry. In Tamil language, we can write Kavidhigal Ezhudalam. That is the kind of amplitude and width of the thing that a person can do, and many purposes could be served. Cautiously adding what Sundararaman has clearly said about the purpose cannot be tax avoidance, which can probably be hauled up by the income tax authorities, and there could be difficulties arising, though caveated by the decision in the other case, which some Arvind or Narottam, something Sundararaman was referring to, a wonderful decision with the particular proposition which he read out. So therefore, the demerger as such is we can talk about a plain and vanilla scheme of demerger where this 19AA is focused, define it, the contours are within that, and exactly fit it like the the box ticking exercise or the pigeonhole method. just fit in that and then go ahead with it. That is called the plain and vanilla scheme of demerger. There could be demergers which are slightly complicated, more complicated. There could be scheme of arrangements where demerger is one of the arrangements happening. Generally, in NCLT practice, what we have seen is over a period, I will today add a very important point here that unlike the previous era where the 391/94 high courts were sanctioning the scheme of arrangements, amalgamations, mergers, demergers, etc. Current dispensation from June 2016 is now guided by a technical qualified expert as a technical member, and the scrutiny is tighter and line by line, and therefore it is not a cakewalk. If you think current generation of demergers and mergers or scheme of arrangement is going to be a very easy task, it is not so. The previous regime had a broad judicial wisdom applied, and they see whether any prejudicial arrangement is prejudicial to the interest of any of the shareholders was the broader premise they had. The denominator was that. All other things were considered as procedural on the aspect of scheme of arrangement. Tax, the tax authorities, regulators take care, sector regulators take care, and therefore the high courts were looking at it in a very broad way, which in fact was very good for enabling commercial decisions happening and the corporate actions happening. Previously, that was the kind of vision, and broadly they were looking at whether the scheme or any part of it is prejudicial to the interest of any of the stakeholders. So when that way you look at it, all other things will be receiving a maybe one notch down. Therefore, importance would not be so much attached to line by line items and see that this is not complied with, there is a deviation, this is not acceptable and all. But current regime is not so. It is not that liberal as we think about. Therefore, we have to be very cautious, and that is where this comes. Though we are discussing about demerger, the culmination of a demerger scheme will be an amalgamation of working of several people, including the business managers, business strategists, so chartered accountants, company secretaries, lawyers, cost accountants, regulators, sector regulators, and tribunals and courts. So amalgamation of all these things will result in culmination of a scheme of arrangement getting ultimately sanctioned, where generally there are two stages. One stage is where the consent of stakeholders have to be obtained through a meeting summoned by the tribunal or under orders of the tribunal with shareholders like the equity shareholders and class of shareholders, similarly unsecured creditors and secured creditors. There are schemes where we have argued there is no compromise, there is no dilution, there is no compromise or arrangement with any creditor's rights, and yet the courts have, tribunals have not dispensed with meetings of unsecured creditors. So the summoning of meeting of shareholders and creditors under the orders of the tribunal is the first stage, wherein the approval of the stakeholders is obtained through the process of general meeting. And of course, in terms of quorum and number of people and all, the tribunals have been always very liberal to fix a prescribed quorum. For example, in unsecured creditors, let us say 100 unsecured creditors have to be present. But within 30 days, if somebody is not present, whoever is present shall be the quorum. Such kind of liberal orders are passed so that the things move to the next stage, particularly because there is a proviso under section 230 subsection 4, which definitely gives a 10% shareholding a right to make an objection to the NCLT. Similarly, a 5% debt on the value of total debt, the creditor gets a right to make an objection to the NCLT if they come to know that there is some problem with the scheme of arrangement and they are, because of that, aggrieved as a result of that. So at the stage of petition, which is the next stage, we call it as the second motion petition. The courts order notices to the authorities and thereafter the scheme gets sanctioned if there are no objections from any quarters. And generally the RD, ROC will be involved. OL will not be involved in a scheme of demerger because liquidation may not happen in demerger unless it is a comprehensive scheme of arrangement resulting in demerger and post facto or immediately thereafter amalgamation of the resulting company or demerged company with any other company. So there could be a scheme of arrangement which is comprehensive and which is structured, which is consequential. There are a lot of things which we can be doing in a scheme of demergers. Broadly, these are all the stages. And timelines. See, one of the things we always find it difficult is very difficult to cut down the timeline in this process. The main reason is that generally what we observe is there are difficulties because the scheme itself is not completely comprehensively drafted. Aspects of taxation, accounting, legal compliance are not completely comprehensively taken into account. The other reason could be the tribunals are already overloaded with several tasks, and every day every bench is dealing with 40-50 matters, and therefore the schemes may not immediately come up before the bench, and it will not come on the board, and even if it comes on board it could be moved to another date. And by the process what happens is from the conceptual stage to cost list stage itself, the journey could be anywhere between 3 to 9 months. And thereafter, it has the two motions of application, approvals, and petitions and hearings and all. And by the time the order comes and you file, so this process may take definitely a minimum of 5 to 6 months minimum. And if everything works like a well-oiled machine, probably you will be able to tell the clients that in 6 months' time the journey could be seeing a culmination. But there are cases where years are taken. There are cases where scheme of arrangements are complicated, so it takes a lot of time. The other point is about the requirement of certificate with respect to the chartered accountant certificate with respect to the accounting treatment. What is written in the proviso in section 230 subsection 7 is company's auditor shall issue the certificate on compliance of accounting standard. So therefore, it has to be a mandatory requirement that even before the board approves the scheme, the scheme is presented to the board for approval, board of directors. It is at that stage, everything must fall in place. Therefore, the other parts do not have any difficulty. Similarly, when it comes to listed companies, the requirements are very clear. You should go to the SEBI, get it cleared before even you file the first motion application. First to beta, then to school was one slogan those days we used to have in beta stores. So go to the bata store, buy the shoe, and then go to the school was the slogan of those days. Similarly, go to SEBI, get it cleared, then file to NCLT. But that is not the case with respect to other authorities like income tax and all, because they are general authorities. Notice comes at the petition stage. And generally, the Vodafone case and all, the courts have always held that the arrangement which is sanctioned by the court or tribunal does not come in the way of tax authorities demanding their pound of flesh later on. So there could be that complication coming up. And under the Companies Act, by virtue of your, the provisions 233, for example, there is a possibility of a scheme of amalgamation and demerger, which are plain and simple, getting through under the 233 route with regional director giving the approval with a 90% consent of the stakeholders. Therefore, there is an ease of doing business to that extent. And the MCA has delegated the powers to the regional directors, which means a scheme of arrangement in the nature of merger or even demerger in relation to holding companies, subsidiary companies, or in relation to the startup. Startup is included in the 1st February 2021 notification. So between startups or startup and small company or between small company holding subsidiary, the scheme of arrangement through the 233 process can also be achieved, which means you are able to achieve it far. In fact, we have presented to the Ministry of Corporate Affairs recently that where there is no dilution of interest of stakeholders, creditors not compromised, and the scheme is already having the approval of the general body of shareholders and creditors with whatever threshold of 75% or 90%, the 233 should be broadened. But in 233, there is always a kind of notion that a court order is not there. Therefore, further, evidencing the title to the transferred undertaking. Stamp duty purposes, you go and deal with the revenue authorities. Therefore, there is always a notion that a 233 is less in authenticity compared to 230 to 232. That kind of a notion is also prevailing. We should remember that also. Apart from that, in IBC, you can bring a 230 scheme. And even when company is ordered, the debtor company is ordered to liquidation, a 90-day window is created under the liquidation process regulations for schemes of arrangement, because companies the acquirers may not want to put money on non-core assets. So the non-core assets will remain on the balance sheet of the company or corporate debtor under liquidation. Core assets, business undertakings identified and defined could be demerged through a scheme of arrangement. In a liquidation also, of course, it is not a new concept. We had the same thing under the Companies Act 1956 previously also. So when there is no dilution, when there is no compromise with the creditors, and if it is a class of company, you try 230, or it is a smooth scheme of arrangement in the form of a demerger under 230, 232, or under the IBC read with regulation 2B of the liquidation process rules. So there are a lot of things which we can do in the scheme of arrangement. I just thought I'll share with you just 4 schemes and mention 1 or 2 minutes for each of these schemes. Kindly see the scheme on the screen. You will find see here the scheme is considering a demerger of one of the cases which we have handled recently. This was a very classic case where we have a demerger, we have a reduction on cancellation of equity shares of the demerged company, as well as reduction and cancellation of share capital of the demerged company. Identified shares also removed. So therefore, the scheme of arrangement could be a very comprehensive one, wherein so many components could be achieved through a single scheme of arrangement, which also is shown here on an illustrative basis, because there are 2 important points emerging here. Number 1 is the efficiency of completing the scheme within or less than 5 months or 6 months. The other point, of course, is a very interesting point, is despite there being no compromise, the NCLT refused to accept our request for dispensing with a meeting of unsecured creditors. However, we advise the companies to go ahead with the meeting of unsecured creditors, and at the same time, we also moved the appellate tribunal, and the appellate tribunal was pleased to sign the dispense with the unsecured creditors meeting ultimately. So what happens is we don't lose the timelines in that. So this is one of the very classic case of a demerger forming part of a scheme of arrangement with both sides, the resulting company as well as demerged company, looking at some reduction of capital of identified shares or shares cross-holding. So this is a very complicated scheme achieved in a very comprehensive manner, efficient manner within 6 months, with some interesting stories for meeting of unsecured creditors, where we finish the meeting, but NCLAT says, okay, you don't need to hold the meeting. And this is a very interesting part of it. There was also another scheme of arrangement which is on the screen, which we have done in the matter of private companies in this region, which incorporated vertical and horizontal division of IP assets and trademarks, and also stores of different formats like retail formats, large formats, exports, imports. So it's a very complicated scheme of arrangement in the matter of JG Hussaini Private Limited, which was also achieved in a matter of less than 6 months. And this scheme of arrangement is an illustration to show how a demerger could be not so easy to be defined as a demerged undertaking, as is the way you can see in, for example, where is that ITC was there? I'll show you that also. Scheme of arrangement. You see, Sundararaman was also mentioning about ITC, 3% is the stake of the hotels. And you see the ITC scheme, and in ITC scheme, you will find in para number, you see the rationale and the scheme. The ITC is considering the demerger of the hotel division. That is the background. ITC Hotel. The demerged company is diversified, and the hotel business of the demerged company, which includes ownership, licensing, management of several hotel properties, providing services, is being demerged. So that is how the demerger is worded. And we can go to page number 24. You will find consideration and discharge of the consideration. This is something which we have to read every paragraph of it which has to be read, because it is a listed company, and the scheme provides for you can see here, issue and allotment of equity shares credited as fully paid to the members of the demerged company holding ordinary shares and whose names appear here, and the ratio is provided there. And down the line you will find several things have been mentioned here in relation to the consideration part of this scheme itself. It's a very interesting proposition and very interesting way in which the arrangement is being done, because this has NSE, BSE, nationwide trading terminals, and resulting company shall apply for listing of its shares on the BSE and NSE and enter into such arrangements and give such confirmations and undertakings. Therefore, this is another interesting scheme where you will have to read and understand it. I'm just highlighting it for the sake of our audience. And also you see the latest scheme of arrangement in the case of Raymond's. In Raymond's rationale, first we will see in page number 1 itself. You will see the rationale for the scheme is that they are looking at demerging the real estate property, the real estate business, into a wholly owned subsidiary. Remember, the resulting company is a wholly owned subsidiary, and it is called Raymond Lifestyle Limited. Under the scheme, it will be named as real estate, property, Raymond Property or Raymond Realty. That is how the scheme is provided. And maybe we can read another aspect of the scheme, because it is a wholly owned subsidiary, and transfer of undertaking, how it is defined, can be seen in page number, para number 4. But para number 5 is important, where since it is only wholly owned subsidiary, entire issued, subscribed, paid up share capital of the transferee company is held by transferor company. And therefore, consequently, transfer of business undertaking, that is real estate, by the transferee company to the transferor company, no shares will be issued. That is another interesting point. And this is another interesting requirement of para number 6, accounting treatment in the books of the demerged company, that is RL, and in the books of the RLL, which is the resulting company, which has to be read, the Lifestyle Limited resulting company. So para number 6 is somebody who is interested in reading how this accounting treatment is captured in a language, in a narrative form, and reducing the complicated information and analysis provided by Chinnaswamy Ganesan sir in language can be understood in para number 6. Similarly, the valuation part of it, the exchange ratio part of it, the scheme provides. And very interestingly, in 26, you see the impact of the scheme of shareholders considered by the audit committee of this. They have clearly said it provides flexibility to the demerged company in scouting for and inviting potential investors, and thereby resulting in unlocking the value of each of the project. And this is a very important opinion, and you will find certain, the diagrams are here. These shadowed properties are going to be retained by the demerged company. The other portion will go to the resulting company. You see like our JGH scheme, which we have handled, survey numbers, project numbers, everything is provided. See, these are all the some of the schemes which I thought I will share with you in order to elucidate the various interesting portions of the scheme. But when it goes to NCLT and we file a structured application and petition, a very limited information is being asked, being shared. But before going into that stage, huge complicated involvement or amalgamation of several professionals are involved, which will ultimately bring out the corporate action, turning it into a reality. I also looked at whether we have demerger anywhere in the Companies Act or rules. Then I was happy to find that in INC 28 there is a mention of demerger, which is filed with the court's order, and they refer to even 391/94 and all. And that is how I think we have broadly covered the 360 degree of this scheme of arrangement. We invite, of course, audience. I pass it on to the moderators so that if there are some questions in a few minutes, we will be able to clarify them. And mostly, I guess it will be addressed to Sundararaman and Chinnaswamy Ganesan. Thank you. Right.
Thank you so much, sir. Now, since
We will
we
try
have
and bounce it off to you. We will try and bounce it off to you.
Understood. See, we can manage any question in the legal language. If you don't convince the court, you confuse it.
Thank you, sir. Now, since
Yeah.
we have 5 to 10 minutes left, in case anyone has any queries, you may please ask the same.
Manoj Singh Bist was, telling that he will be sharing some thoughts. Mr. Manoj Singh Bist, he is from Rakit Colony.
Sorry, I was not able to unmute.
Yeah, you are now unmuted. Yeah.
Yeah. Hello, everyone. Hi. So I was just wondering, insofar as ITC case is concerned, if you see their hotel business is comprising of two set of things. In fact, three. One is the leasehold land which they take from, sometimes from the state government or from some other party, or an owned land, or a leasehold land with a building which is owned building, which is constructed by them, and it is not a shed; it's a proper building. So they have in fact not really called out as to what is the exposure from a stamp duty perspective. And ideally the reason for that is because they don't even know what is the exposure and what is the legal battle which they foresee. Because if you see state of Tamil Nadu, even on lease, that stamp duty is huge because they treat it just like any conveyance, if I'm not wrong. In Delhi, there is a different scenario. In Bombay, the law is settled, right? So the way I look at it is, if you see from a stamp duty perspective, some of these, schemes are also done from a stamp duty perspective. A lot of, shifting of registered office happens primarily to handle the stamp duty exposure. For example, in Delhi, it is 3% flat on certain things, right? So you don't have an upper threshold. Whereas in Chandigarh or in Haryana, for that matter, it is marked up to a threshold. So you have a capping, your exposure in the state of Haryana. Whereas in Delhi, that exposure is huge, depending on the market value. So that for ITC will remain a challenge for next 10 years, if not less. Is my guess. Even in state of Tamil Nadu, you see even people are struggling for last 15 years resolving disputes. Sometimes they rake up the dispute by issuing circulars time and again. I think there was a judgment recently in 2024 also of the Madras High Court. But the real issue is of registration also. Whether these orders of the court are to be registered with the registration authority under the Registration Act. Because one of the exclusion in section 17 of the Registration Act is for orders of the court. And therefore, generally an instrument of conveyance is required to be registered. But orders of the court are excluded from that realm of section 17. However, my question to Dr. KSR was and remains to be is whether an order of an RD whether an order of an RD under 233 is also liable to be registered or not, because section 17, whether we should read it strictly, if you go and read it strictly, then that exemption for orders of the court may not be available. So that exposure of registration also comes into play when you would like to decide whether you want to do via an RD route in a state where even registration of such documents is costly. Dr. K. Sir.
So far as the impact of a scheme of arrangement or demerger, whatever is sanctioned by or approved by the regional director under 233 is benefit of subsection 9 of 233 is always there, which is equal to 230, 232. From the angle of court sanctioned schemes and the RD sanctioned schemes, even a tribunal is sanctioning now under 230, 232. So what we do in in the recent times, the government of Tamil Nadu has introduced a stamp duty with a clear notification. Therefore, registration has not created much problem in terms of the scheme or order of 233 being registered. So what we advise is, it is always better to do a registration. The transfer of undertaking through a 233 order is also covered by the reduced rate of stamp duty applicable for amalgamation and demerger. Therefore, as long as company is liable to pay stamp duty, and the stamp duty on 230 and 233 are governed by the reduced rate of stamp duty, you will
It's
be
2%, I believe.
Yeah, whatever it is, that reduced rate I'm saying, because different states have different rates, and that particular advantage, compulsion to pay stamp duty is mandatory, therefore you pay it. Once you are ready to pay the stamp duty, registration fees is not a very high sum, at least we can say in Tamil Nadu.
Right.
Yeah, over to other participants if questions are there.
Sir, there is a question from one of the participants, Malati.
Yeah.
She raised a query that in case of a demerger of a listed company, is it necessary or mandatory for the resulting company to be also listed?
We had long before, I think my office has given me a printout of the opinion I gave in 2006. That was a case where Hindustan Unilever demerged its plantation in Nilgiris. And the consideration was 60 crore only at that time, 2006. And therefore the scheme provided not in accordance with 19AA, but for payment of compensation to the demerged company. Because the Hindustan Unilever is such a big company with large shareholding, you can't issue the shares of the resulting company to the shareholders of the demerged company for a small value. And therefore, there are schemes which are written, which are conceptualized in the light in which it is done. For example, Sundararaman was very beautifully articulating BEML case and the market cap and all. You take, for example, ITC scheme. The hotel may be only 3% on the combined balance sheet. Tomorrow, after it is hived off, all rights flow to the resulting company. And the scheme provides for listing of the resulting company's shares. It is not compulsory, but if you are already a shareholder of a listed company and the resulting company's shareholders are going to be receiving illiquid stocks, how it will work? Therefore, unlocking, monetizing, seeing great growth in the value, and naturally it becomes like that. Though there is, as a matter of rule, it is not said, the resulting company shares should also be. That is why we have a 25% window under the Income Tax Act also. So you can always retain shares with illiquid shares with the 75% majority, and 25% could be given the option to get immediate cash as per the share valuation, because it will become illiquid stock or difficult to trade. So there must be option available in the scheme itself. So depending upon the mechanics and goals which are required to be achieved, the scheme could be drafted in a manner in which it could be beneficial to the stakeholders and SEBI is supposed to clear it because anyway a listed company is part of the scheme, and also tribunal is looking at it. Shareholders have the right under the subsection 4 proviso to come before the NCLT. Therefore, I think no scheme is going to be passing through this entire structures unless it takes care of the interests of all the stakeholders. Thank you.
Thank you, sir.
Sundararaman, would you permit me to ask one question to you? When you were presenting on the GAIR aspect of it, I had the question whether the income tax can probably look at it, and your language in that subject was recharacterizing. Such a big language is used, recharacterizing. So I wanted to know, see, when we are giving notice under the 230 itself, we are giving notice to all the departments, which are now mandatory and specified in the section itself. The section itself provides for notice to the government authorities, and it clearly talks about notice to Reserve Bank of India, notice to central government, income tax authorities, SEBI. So when the notice is specifically given with the scheme in front of them, we cannot wait, the tribunal cannot wait, nor the stakeholders can wait for n number of days or months and years for any assessment to be done. So recharacterizing, in my opinion, should be probably invoked or resorted to in case there is some fraudulent scheme or a device for some other larger purposes hidden from the facade of the scheme.
Yes, because there have been cases where the income tax has objected some schemes. One case, if I remember correct, I had shared the scheme or the case also, where the income tax objection was overruled by the NCLT and they have sanctioned the scheme. Now, in that case, if you see, that's a merger, that's not a demerger. But in that merger, a loss-making company is a profit-making company is merged with a loss-making company. What they are saying is this is clearly a device to tax advantage they want to take. This NCLT said no, that is available in the law, so they can take. But in that case, the income tax department has already objected. Now, if it has an impact of more than 3 crores technically, but I think that was before the GAR was notified. If after GAR notification, if this case has happened, if they have already objected in NCLT, they can always now say, I will not accept this, I will not allow this adjustment of losses. So I will consider this unit to be continuing to be with that old system, because the law empowers them. I don't know how that will be viewed by court tomorrow, how that recharacterization. But the technical possibility where they have already objected when the scheme was notified to them, and the NCLT has this one. So in all these cases, whenever the scheme should make a provision that in the event that this is not accepted, the liability on tax will be met, in our opinion, by about say 100 crores or 500 crores or whatever, for which fund should be earmarked and kept by the resulting or the demerged company, because both will take away the running units. Tomorrow, no, whoever is saddled with that notice and this one, the shareholders should come to know what will be the impact if that happens. That is my viewpoint. But where they have not objected, in fact, in one of the NCLT appearances I was doing for some other case, a case of merger came across. The technical member was earlier an income tax commissioner who had become the technical member. So he was saying, no, one notice is not sufficient. You give one more notice. Let us wait for one more notice. So he was taking that very liberal view towards the income tax. But if all notices are served and they are not responding, or they are giving a blanket saying that no, we will decide about this is without to tax it. But in those cases, if it is not articulated when the scheme is not there, I think they cannot do it when But if they have articulated something in the scheme, and in the case which I was referring, not only the income tax officer, the regional director endorsed the income tax officer, and he also objected to it. The NCLT overruled both of them and gave permission for merger. So if such a thing happens, then I think we are in trouble because of GAR.
Right. Excellent.
Manoj,
Manoj, you wanted to ask something?
I had a question for Sundaram sir. Basically, when you said that in the scheme there should be a provision, you know how the regulators approach anything, including a scheme, right? Especially the income tax department. So a presumption of you having that, some risk assessment you have done when you went for a demerger. Now you basis that risk assessment, you have put in a clause of GAR and provision for addressing GAR exposure. Don't we think that the income tax officer will start with that as an argument to say that, look, you yourself have written in the scheme and there is a likelihood of being an exposure, and therefore you have also created a provision, etc., etc. How do you tackle that aspect of it? And also your auditors, your tax auditors, how do you tackle that if you go in and put that kind of a clause, right? For example, in related party transactions case, so some of the companies, and we keep discussing, they tend to encourage and put a clause that in case the transaction is tested under 188 or under LODR, and there is a gap found in terms of arm's length pricing, not the ordinary course part of it, but the arm's length pricing, the price be adjusted in such a manner that both the parties are able to comply with 188 and LODR in substance. So retrospectively, you may correct some things to avoid anything which prejudice the whole transaction, because there are long-term RPTs also, right? So that is also going on as a debate, and this also now adds on to that. I'm just trying to connect two dots and just discuss how do we put this expressive language in the document which will be Bible for us to follow, and how do we tackle the authorities then?
Here, in my view, the move should not be from the professional. When we draft a scheme, we don't give credence to that likely liability and all, because nobody will give. The push should come from the NCLT. When an objection should immediately require that the parties commit on what will be the effective GAR is applied. At least make a submission and bring it into the order of theirs, saying that in the case of GAR, if such a thing, see, they have said that they have right to collect, they have right to apply the provisions of law also, they have said. But if a recharacterization happens, the amount of hell will fall. Because in one of the cases where we have done the merger, when our Calcutta office has done the merger, the NCLAT to do NCLAT and they reversed the process. So after all filings after NCLT, now NCLAT, we are before NCLT seeking permission to revise the accounts. Then file the, so this sort of difficulty, and after so many years, what will be the impact? Some such study has to be done, and the NCLT, wherever such a case is there, they should very clearly spell out that GAR if it is applied. In which case, if the department says that we are objecting to it, the objective blanket things. What are the steps that you contemplate in case this is done? It cannot be that mere objection that I don't object. A scheme cannot be a sort of either this or not this. If a scheme goes into the NCLT, and NCLT is supposed to look at all aspects and then come to a conclusion. In which case, the department also, when they object, they are supposed to say that this scheme will result in this much of liability of income tax if this is not given credence under. Clearly, when an objection comes, the maybe the time taken for sanctioning the merger could get delayed. But this is how, if you are going to brush aside the entire objection and leave, after 5-6 years, there will be nobody to lift the can. That is my viewpoint. And if at least at that time the scheme has to be amended, or it has to have a provision for wherever such a objection comes from the income tax. I do know that to amend a scheme is going to take another 1 I mean, much more than what a fresh scheme gets sanctioned. Is that okay?
Yeah, absolutely. I just want to share this thought with you. The Capital Market Regulator, Competition Commission of India, in case of large combinations. Reserve Bank of India in case of sector regulated and several other sector regulators. And income tax, for instance, in this case. All these things must be pre-clearance and therefore complications post facto are totally avoided. Tribunal sanctioning becomes a smooth process. But that is not how it happens except for your sector regulator or competition commission or a capital market regulator. In income tax, it is always because it requires a lot of understanding, analysis, post facto impact and all. So they have this issue. Leaving at that, because different schemes bring out different dimensions and at different points of time. At the time when you consider it has some dimension, post facto it throws up, oh, this is so like that we used to be looking at it with awe or with some other shocks and surprises. So it is like that. But I thought I will ask two questions to Chinsami Ganesan's expert clarification. One was on, he was mentioning specifically on the common cost accounting. If he can give some guidance on how this common cost accounting has happened in any scheme or some illustrative thing, it will be useful. The other thing is, now that you have the 234 on amalgamation of foreign company, amalgamation between Indian company and foreign company, the accounting standard impact, how does it work between two jurisdictions? Are we having the same international financial thing or are there differences? How does it work? Just two questions, kindly clarify because it is already too late. So I don't want to really trouble you and also maybe you are hungry.
Yeah, I will take the second question first because it's very easy to answer. Because whenever you are accounting for assets and liabilities, harmonization of the accounting policies is one of the important aspects. So if you have a different accounting policy, for example, US GAAP and Indian accounting standard, when you are trying to use that for the purpose of doing it, the accounting policy should be harmonized, and to that effect, the adjustment may be required when before you give effect for the assets and liabilities in the resulting company. This is the simple principle, because the concept itself is same, because you wanted to look at apple with apple rather than apple with the oranges. That's the easiest way of looking at. Regarding the first question relating to common costs and common assets, the apportion method is the really a challenging aspect. The simple way of looking at could be the fair value of assets of the demerged company and fair value of the assets of the resulting company could be one of the parameter which you can use it for allocation of the assets and liabilities. Similar to that, you can also consider the common cost to be allocated between the two. Could be the logical or maybe a reasonable way of looking at allocation of the costs.
Thank you very much.
Thank you, sir.
Over to moderators.
Thank you, sir. Do we have any more queries? Okay. I would like to thank the speakers and also the audience for taking out time and participating in the webinar. In case someone still has any further queries, I'm just sharing the screen. You may send your queries to this mail ID.
Okay, thank you.
Thank you,
Thank you for
everyone.
the opportunity provided here. Thank you. Thank you, KSR, sir.
Yeah, absolutely. See you. Thank you. Thank you,
Thank you.
Manoj.